This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. It is 8 p.m. Eastern Time. It is still very much a lot of sunshine here in Florida right now, and we have some folks in Arizona who are actually being threatened by a wildfire out there, and I'm keeping an eye on that. I really feel sorry for those folks because the wind has shifted, and we have friends out there that have been called to evacuate. So a lot of things going on in these summer months, and the volatility it looks like it's starting to increase in the markets as well. I'm going to get to that in a minute, but again, I want to welcome all the new folks who are very much joining for the very first time, and we will be taking questions and answering anything related to your stock positions. I'll be analyzing stock symbols, and we're going to get going right now. This is the Russell 2000. And as I do at the beginning of each open house Q&A, I look at the forecast that I put out on Friday. So these lines right here are my forecast lines, and you can see that my forecast was that the Russell 2000 would go up just a hair. Today's high matched almost perfectly with my pivot point right there, and we'll have to see whether or not the follow through takes place to the downside. If you look at the stochastics here, you'll see that the momentum is still heading lower, as well as the CCI is still heading lower, and we are in an oversold condition right now, but that doesn't mean it can't get more oversold. And if you look back here, you'll notice back in May, first and into the second week of May, we were oversold. The CCI ticked up, and then it started heading down, very similar to what we see now. And the CCI continued to go lower, and the markets dropped quite dramatically at that particular point. So again, whether or not that happens, we'll have to wait and see. Today, the Russell 2000 closed below the gap fill support level. So that would be a negative. And I'm not looking for a collapse in the market or anything like that. I am looking for a continuation of the downward pressure before we get some relief and find some support. All right, so that's the Russell 2000. If we look at the VIX, which is more or less a leading indicator, it's inversely related to the S&P. Although we had a red candle for the VIX, we had a higher low and a higher high for the VIX. So that is in keeping with my forecast right here. I said that the VIX would most likely head higher. We are not quite in overbought territory for the stochastics, and we're close to overbought on the CCI, but I think that we could still go a little bit higher on the VIX. We'll have to see with that. You know, we have some earnings coming out for the rest of this week. Whether or not that's going to affect prices overall, we don't know. Again, there's a lot of unknowns, and I just think that the best way to forecast is not to look at the analyst recommendations or the ratings, but to look at the charts. And we've been really very accurate in the forecast, not 100%, but never is anyone 100%. But if you've been following along with the weekly market report, you'll know that, again, looking back at this particular chart, each one of these lines back here are forecasts that were put out. I haven't erased them yet, but you can see that the forecasts were right about 8 out of 10 times right there. So the VIX is still expected to go a little bit higher. If we look at the S&P, that would mean we're expecting the S&P to go a little bit lower. Now look at what happened today. This line, this diagonal line, is right in line with the target being the support gap fill point right here. This is a spinning top, and we're seeing that on lower volume. So this might be a mixed signal, because a drop in volume with a spinning top after a bearish engulfing pattern, this 2-day pattern is giving us a mixed signal, because that's a harami, and harami is usually bullish. You can see back here was a harami. This is a small spinning top found within the body of a previous red candle, although this happened as the gap was filling, so that was a good excuse for the rally after that. But this harami is right at a 20-period moving average. So we'll have to see whether or not it bounces before going lower, but I'm going to hold on my forecast that by the end of this week, we're going to see lower prices. And if you're long any stocks, think about this. You should just be using these signals as a measure to protect and put your stops in place, because you can't really get a better place to put a stop right now than right below the 20-period moving average. So if you're long any positions and you think that there is a possibility the market can drop like I think it can, then put your stop below the 20-period moving average on the individual stock position and don't look back. Because if it breaks out below the 20-period moving average, it'll probably continue lower. And then when the stock finds support, guess what? You jump back in. That's all you really have to do at that particular point. And don't be afraid to get back in on a buy signal or a support level or a pivot point or any candle that's bullish, right? That's the S&P. The NASDAQ, interestingly enough, is showing a similar pattern where we have a lower high, but we do not have a lower low. Therefore, this too is a harami. Now, when you have a bearish engulfing pattern, which this is a significant one, and I said that last week on the weekly market report, you cannot ignore that. And if you had to weigh the evidence here and you say, okay, well, which one carries more weight, the bearish engulfing pattern or the harami? Well, when they're side by side like that, there is a technique in technical analysis that I found many years ago as a member of the Market Technicians Association. They call this the summation principle. When you have two back-to-back and opposite signals, here again, the bearish engulfing pattern followed by harami, what you do is you combine the 3 days as though it was one. Now look, if the market closed here on, what day is that, the 18th, on this high, and then we close on this low, and then we closed on this high again, this is very close to an inverted hammer, because if you combine all these, the high would be up here, and you would have a long shadow. Again, if let's say the opening is here, the close is here, this would be a green body, but you'd have this long shadow up above right at a resistance point. So the 3-day pattern, if you're using the summation principle, is still negative. And that's what I'm going to go to. It has nothing to do with my opinion. It has everything to do with the evidence that we're seeing on the technical charts. So that's the cues. Now, if we look at the diamonds, there we go. This one is a red candle. It is a spinning top as well, but unlike the S&P and the Qs, we have a lower high and a lower low following this bearish engulfing pattern. All right, so out of all the markets that I've looked at so far and analyzed with you, the diamonds is the most negative, because we have this continuation of the downward pressure with a lower high, lower low, and all of the momentum indicators are still going lower. All right, so keep an eye on the diamonds. I don't think this is a gap. Let me just take a look at this. That high is 268.12. This low is 268.17. Okay, so there is a 5-cent gap right here I'm not going to draw that line because I need these lines to carry over to next week's market report. But this is still an open gap. It's a very minor one. Like I said, it's only 5 cents, but a 5-cent gap is as significant as a $1 gap. It's an open gap, and open gaps fill 80% of the time. They do act as price magnets, and we have to look at that as, again, evidence that there's still selling pressure. One other thing I want to point out, and I continue to do this, especially on the monthly open house Q&As, we have, again, still, the market is still in an upward trend since the lows in 2008. But I want you to look very closely at what's happening here in this area. We have this month so far, we have higher highs here. So we have new high territory, but this is very similar to a head and shoulders pattern with one exception. A head and shoulders pattern usually has a lower high on the right shoulder. This has a higher high. However, the volume is still dramatically lower. Now, we still have a lot of time left in this month. You know, we still have about another week, but I'm telling you, I do not think that the next week is going to build enough volume to surpass last month's volume. Right, so it's very, very important. And the other thing is, and I can't remember which week I pointed this out, but you have, again, this is a monthly candle chart, okay? You have a bearish engulfing pattern on the monthly here. You have a bearish engulfing pattern on the monthly here. You have a bearish engulfing pattern on the monthly here. And the most recent bearish engulfing pattern has not resulted in a pullback yet. But this drop in volume is something you have to pay very, very close attention to, because if the markets are rallying to new highs on light volume, that's not an indication of continued buying on a large scale. This could just be a thin market being pushed up to higher highs, but there's no significant volume there. And therefore, when I am looking at a position, especially as an option trader, and there's a lot of option traders on right now with us right now. I'm looking at some of the names, right? Dennis is there. You got Bruce is an option trader. You got Eric up in Canada. He's an option trader. Gene Otto, welcome back again. Option traders all around. You know, we as option traders can make money on the way up. We can make money on the way down. We can make money by selling spreads in a sideways market. But as an option trader, I'm telling you, I am positioning bearish strategies when the market rallies. So in other words, what I'm doing is I'm selling into the rallies by taking bearish option positions that will make me money on the way down. Now, again, Boeing is a good example of that. In the option report, I said Boeing would most likely rally. Boeing has done that. But hopefully someone's going to bring up Boeing in the conversation. Boeing technically is looking a little weak right now. And therefore, if you're an option trader and you want to take a bearish position, this will be a good time to do that as well. All right. So there we go. We talked about the Russell. We talked about the VIX, the spiders, the Qs, the diamonds. All the markets are covered. Now it's your time to ask me questions and or put in a stock symbol. And I see, Richard, you have one in there already. If you put in a stock symbol, please do what with folks like Rick are doing. Rick says, I have a long position in GLD and SLV. What's my outlook? So if you want me to look at a position, please let me know what your interest is. Do you hold it? You thinking about getting in it? Have you just sold it and you want to trade it? Let me know, so that when I look at the signals, it'll put me in a better position to be able to help you better, okay? All right, so Jim says, a stock gaps up and continues to move up several days and then gaps again, moving up a few more days, then moves down and fills the second gap, then resumes its upward movement. What are the odds a stock will fill the original gap? Okay, that's a great question. If you have a stock, Jim, put it in. If not, I got one. And I'm going to be killing two birds with one stone right here. SLV is one of those stocks where if I go to the daily chart, okay, SLV gapped up, okay, it gapped up again, and it gapped up a third time. All right. This, when you have three gaps in a row like this is a breakaway gap. This is a runaway gap. This is called an exhaustion gap. Right. So, Jim, pay very close attention. When you have three gaps, especially three gaps in a row, and then on a day like today, you see a dramatic drop in volume. Let me zoom in here. Right. And Richard, this actually, Rick, this will help you as well. I am completely out of my SLV position on the third gap. Now, this was one of those times where I was talking to another trader friend of mine, Fred, who was a former mentor student, now making tons of money trading. Fred and I had SLV. We sold out on the third gap, and what happened the very next day? Boom, it went higher. Can I tell you that I had seller's remorse at that particular point? Yes. But that was only my greed talking to me. It wasn't my common sense in looking at the chart. The next day, which was Friday, it went higher. I'm going, oh, geez, there's going to be four gaps in a row? Because it did. On the opening, it opened up here. And for the first hour and a half, SLV had four gaps in a row. And I'm thinking, okay, well, it's got to come back now. Well, look what happened. Closed with a red candle. Today, it closed with a spinning top on volume that is less than half of what it was last week. All right. So what happens when you have three gaps? The odds are that even when you have three gaps in a row, that the stock will pull back and fill the original gap. So if I'm using SLV as the position, there is a very good chance the stock could pull all the way back to fill this gap. And if you look at where that gap fill area would be, it's very close to the 20-period moving average. That's number one. If I erase all lines, I'm going to show you something that I don't do often, but I'm going to use the Fibonacci retracements because this gap here, the second gap, is going to be right in the crosshairs of the Fibonacci pullback points too. Watch. I'm going to add a study. Actually, I got to add the drawing, and I'm going to add the drawing tools. Go to percentage. Where is the percent? Here it is. Fibonacci retracements. Now, almost every single charting platform, and even the folks up in Canada have this. We have a lot of Canadians on. With Scotia, their flight desk platform has the ability to draw this. When you have a dramatic upward leg like what you have here, the way you use the Fibonacci tool is you flip to the percentage, the Fibonacci percentage retracements. You start your line on the lowest of the low in that segment, and you drag it out like an accordion. You open up and drop it right to the top. Now, if you look at the 50% level, which brings us to 1475 on the scale, there is a high probability that the stock is going to come back to fill that second gap. If you look down here, the first initial gap is right at, again, at a Fibonacci retracement of 78.9. So that too could result in the pullback. So again, getting rid of my Fibonacci retracements. What do I think is going to happen for SLV? It may not happen in that time frame, but I think it's going to do just that, which, by the way, if you look at the 61.8 on the Fibonacci retracement, can anyone tell me what this level is right here? If I draw a horizontal line from that high, what is that? Can anyone tell me? Who's been with our group long enough to be able to tell me what that is? Let's see. Gene, yes, that is support. A former resistance, once broken like it did back here, turns into new support. So that's called role reversal. If you're new to role reversal and want to learn more, go to the Market Guys website. I have a video on that. The role reversal support level is right at the 61.8. Now, I have an alert set on SLV because my goal is that I'm going to be buying back in but I'm not going to be buying in all one chunk. As it pulls back, I will be scaling in. That's a term that's used by professional traders, where you take a little bit of your buying power, you buy some. If it drops a little bit more, you buy a little bit more. If it drops again, you start increasing the number of shares as it starts pulling back in a more dramatic way. So you're easing into or cost averaging into a position. That is very different than cost averaging down on a losing position. When you're scaling in, you're basically cost averaging down to get into a new position. Now, Paul Farley asked a position, said, would you sell a call spread now? Sure, absolutely, Paul. If you're talking about SLV, I would go something a little bit higher. Maybe try to, I don't know how much premium you're going to get, because there's not a whole lot of premium on the out of the money calls. But yeah, if there's enough premium there, I would absolutely do that. Okay, so hopefully, Jim, that helped you out. And I'm going to go right to Richard, looking at 3M, bought it at 175. Let me pull that up right now. Here we go. There we go, 3M company. Let me see, bought at 175, May support 160, May 31st established gap 184. Okay, I'm going to just go right in here. I think that 3M is going to go higher, and hopefully that's going to help you, because that's pretty close to where you bought it, you know, on the May support level, which is now support at the 20-period moving average. Let me erase these lines. What I think 3M, this is a good one, because I have this one on my watch list, and now this is a great candidate for option traders, because if you look very closely, this is a bounce. It looks almost like a bullish engulfing pattern today. Not quite, but close. This looks like a good strong bounce off of the 20-period moving average. I would have loved to have seen higher volume on that. That would have really been a good confirmation. Now, here's what you have to watch for, Richard, all right? If the stock breaks out, and I think it will, if it breaks out of these highs from June and July, it could easily run, and you'll have to watch for the volume increase. So I'm not going to say it's going to go all the way up to fill this gap right away, you know, up around 215, 220, although I think it could happen eventually. But the reason I think this is going to break out is because if you look at the consistent movement now of the 20-period moving average, it's in a nice, steady upward trend. Okay, that smoothing effect in the 20-period moving average is why the 20-period moving average is so popular. All right, so look at the 20-period moving average. You see it's going up, and look at what we're seeing here. If I connect these lows and draw a parallel line connecting these highs, or close to a parallel line, you have a good trading channel right there. So this is a good one to get in, and if you have it, don't just say, okay, well, AJ's bullish, so I'm just going to hold on no matter what. You're still going to have to manage your risk. Now, instead of putting it right below the 20-period moving average, I would put a stop, if you can manage that, right around 165 or just below 165, because it'll be the support level from back here on June 1st. All right, so that's my spin on 3M. If, again, any option traders, I would take note of this one. I'm not going to put out an alert on this one, but this is one I would definitely trade from the long side. You know, for those who don't trade options, let me just give you a little quick lesson. 3M is a pretty expensive stock. It's trading around $175 a share. But if I went out and I bought a longer term, what's called a leap, and I go out to January, let's say I go out to January, 2021, this option right here that I'm highlighting is trading for around $20. Now, what is that? That option is like you're trading a mini version of the stock. So if you don't have enough in your account to trade the stock itself, you might decide, hey, maybe I'm going to qualify for options. I'm going to learn a little bit about options. I'm going to listen to AJ's recordings, and I'm going to learn options. And then you could start trading the leaps, again, as though it's a mini or a cheaper version of the stock itself. I mean, if you think about this, the diamonds, we talk about it all the time, DIA, what is that? Well, the diamonds is 1/100th of the Dow. It's a mini version of the Dow. You get to trade the Dow Jones Industrial Average, a small sliver of it, by trading the ETF. Now, that's not exactly the same as a leap or a call option like this, but this leap option, this long-term option, does trade in a similar way. All right, so when the market goes up for 3M, this will go up in value as well. Now, again, I just gave that as like a prelude to what you need to know about options. Just don't open up an option account tomorrow. If you've never traded options, go and learn about it. You can get qualified and not trade it until you're comfortable with it. That's fine. Your broker will most likely approve you to buy options. And then you learn a little at a time, and then maybe just tiptoe in, maybe buy one option and don't buy 100 of them, and go on with it that way. All right, so hopefully that helped you, Richard, with that one. All right, now Rick, I talked about silver, but you wanted to know about GLD. Now, again, I'm going to keep going back and forth and flip-flopping, going back and forth to options and stocks here, because I want people to understand. GLD is the exchange traded fund that tracks gold prices on the commodity exchange in New York. All right, now gold and silver don't always trade in tandem or in line with each other. Sometimes silver will go up, sometimes, like it did today, sometimes gold will go down like it did today. Sometimes they do opposite things. But if you look at GLD, here too you have gaps way below the market. I think GLD could easily fill this gap, and it might take a little bit more time for this gap to fill. But if you look down at the momentum indicators, right, today, as I'm recording this and as I'm broadcasting to you, today the CCI has crossed with the sell signal. If you don't know what the CCI is, that's a commodity channel index. It is one of my favorite indicators because it is one of the most sensitive indicators, and even more sensitive than stochastics, which is a very popular one. You see, the sell signal is generated on stochastics when this blue line, the K line, crosses the D. You see that? So we're probably a day away from that crossing. But today, the CCI is crossed with a sell signal. When the CCI goes up over 100, and in this case it went over 200, that's overbought. When it comes back down and crosses below the 100 mark, which is that parallel, this horizontal red line, when it crosses below like it did today, that is a sell signal. So look at everything that's going on. You've got, this is a harami, this is a negative harami. See the small red candle within the body of the green candle? That's as powerful as a bearish engulfing pattern. You got the small spinning top on much lighter volume than Friday. That's telling us the buyers are starting to run out of steam. I'll get rid of this line and I'll leave the gap fill point. So I think that GLD could actually pull back, and this could be a $6 pullback here now on that. Now, if GLD, if you're interested in trading GLD, but maybe that one's a little bit too rich for your blood, you might want to look at IAU. Now look at the price of GLD. It closed right around 134.5, right? Here's IAU. It's trading roughly 1/10 the value of GLD. See, so this is like a mini version of GLD. And so it'll move in the same percentage swings, but you're not putting as much capital into that particular trade. And you look to see the charts, very, very similar. I think that this too could fill the gap, come back down. That would be a 60-cent drop in that one. Remember, I said $6 move in GLD, 60-cent drop here, because same percentage. And that's what we would look at. So, Rick, hopefully that helped you out. All right, I know we have a lot of folks on the call today, so I'm going to try to go as quickly as I can. Philip says, and welcome back, Philip. I appreciate that. NOC is Northrop Grumman, and if you look at this one, this is interesting because Philip says no position, thinking of buying NOC and writing covered calls for income. All right, now you have to be careful because I'm going to flip from the daily chart to the weekly chart. you have a stock that has a green candle today, but it's on lower volume and it just barely, I mean, just by a hair, closed above the 20-period moving average. If it closes tomorrow below that 20-period moving average, that would cancel any ideas for buying. Why? Because if it closes below the 20-period moving average, and that's taken as a failed attempt to rally back up over the 20-period moving average, right? They'll drop in volume, again, is negative. The stochastics is still going up, but look, remember what I said about the CCI? It's more sensitive than stochastics. The CCI is starting to shift down again, all right? So that's the daily chart. But hold on, Philip. I'm going to go to the weekly chart because you got to see this one, right? Look what's happening on the weekly chart. Completely different signals now. You have a stock that is at a resistance point here, right? Last week, you had a bearish engulfing pattern. That's not quite a horizontal line, but here's the bearish engulfing pattern last week. You had a sell signal on stochastics. You had a sell signal on the CCI. So if you're weighing the evidence, let me straighten this line out because I could even go a little bit higher and show you the resistance from here, which was also a bearish engulfing pattern, right? So here's resistance up here. You had a bearish engulfing pattern here. If you look back at all of the previous bearish engulfing patterns on the weekly chart, here, what happened? It dropped. Here, what happened? Bearish engulfing pattern. It dropped. Here, bearish engulfing pattern. It dropped. Here, bearish engulfing pattern. It dropped. Do I have to keep going? Well, I will, because here we have a bearish engulfing pattern. Now, out of the last times we have bearish engulfing pattern, the stock dropped in a dramatic way on all counts, going back to last year, right? So we have a stock at resistance. Indicators are showing sell signals. Now, it's too early to read the volume because it's only Monday on the weekly chart, but you really have to keep an eye on that. What I would do, Philip, is if you want to buy it and you're thinking about writing a covered call for income, here's what I would consider. You can buy the stock even though it's bearish. You might think, AJ, you're talking with forked tongue, right? No, you can. But if you buy the stock at, let's say, 323.20, which is where it closed, sell a far out month in the money call. Now, for those that don't trade options, you don't know what I'm saying, but here's what would happen. If you sell an in the money call further out, you're still going to get premium. You're still going to get to collect the dividend, but you're allowing yourself the stock. If you sell the 300 call, you're still allowing or giving the stock enough room to drop. It could still drop 23 points and you could still make money. So that is what I call a golden buy right. A regular covered call or buy right sells the front month. What I would do here, if you're selling the 300 call, I don't want to beat this up too much, but I got to show you. Ready? It's a beautiful strategy, and I was talking to Fred about this one. If I went out and let's say the January options, right? If I sell the January options and I sell the 300 call, how much am I going to get for the 300 call? I could probably sell the 300 call for $35. Let that sink in. I'm collecting $35. Now, what does that do when I sell a call? Well, if I sell a 300 call for $35, I'm obligating myself to sell the stock at 300, right? So if I'm obligating myself to sell the stock $23 lower, right, but I'm getting paid $35 to do that, I could still make $12 on this trade as long as it stays over 300, and I get to collect all the dividends that are paid out between now and January. So this is an underutilized strategy. I've renamed it. I have two different names for it. I call it the golden buy right or I call it the dividend plus strategy because you're still collecting a dividend. I do this in managed accounts that I trade. I'll put on long-term trades. I'll let it sit, and I could still sleep at night knowing this stock could still drop $23 and I'm still going to make money. Actually, I could let this stock drop $33 and I'm still going to make money because I'll still make an extra $2 in the dividend. So this is a really great strategy. If you want to learn more about that, send me an email and I'll send you a document on how that works. I have a PowerPoint that talks about the dividend plus strategy that I used to teach in Switzerland with the Tony Robbins group. Okay, hopefully that helps you out. All right, now, John, welcome. And John, you sent me a text. By the way, John's part of our mentor group. He's one of our students. John, SLV, I know you sold the puts on that, but be careful on that one. I'm going to look at the spreadsheet that you sent me after I get off here, and we'll talk tomorrow, hopefully, okay? So you're thinking about entering into FTV. Now, FTV does have volatility, as we see from the weekly chart here. This one could make your head spin because it wasn't too long ago, at the beginning of the year when actually it was the beginning, right, January, right here, it was trading around 65. It went all the way up to 90, and now it's pulling back to around 80. But this is what the weekly chart looks like. It doesn't look so bad on the weekly because what we have here is a symmetrical triangle forming. That's what we have right here. If I draw some triangle lines, you'll see, right? So you have a triangle pattern here that looks like it's at the bottom triangle line. You got to watch this bearish engulfing pattern on the weekly. But now let's switch to the daily, all right? Now, if you decide to buy it, the daily charts are looking more positive than the weekly chart because if you look at the oscillators, stochastics is starting to go up. CCI is very close to a buy signal. And if you look at the candle right here, you have a green candle on lower volume, all right? Now, that's important because when you have a stock that's going down, get ready for a question. I'm going to see who's going to answer this first. Some of you are mind readers, so I'm expecting an answer to come momentarily. But if the stock is dropping and the volume is increasing, that tells us that the sellers are motivated. But if the price is dropping, because we still see a lower high, lower low, price is dropping, but we see lower volume, what is that telling us about the motivation level of the sellers? Who's going to answer that? Let's see. I thought for sure there we go, Kim. Thank you. Thank you. Our Canadian active trader, crazy person that stays up to 1 o'clock in the morning looking at trades. Yes, Kim's right. It tells us that the momentum on the sell side is lessening, all right? So if you are thinking about buying that, that's okay to do that, but just make sure you're using a stop and put your stop somewhere below this low right here. You got to draw a horizontal flat line for that. So if you buy it around 79, you got to put your stop around 77. Hopefully that helps you out. All right, now Ron is looking at HCP. What would be a good entry point is what Ron is asking me. HCP right there is actually this one doesn't look that bad. Now remember, I started this session off talking about the markets, right? Now how the Dow looks like it's pretty negative and it could still go lower. Now, that doesn't mean all stocks are going to drop. In fact, some of the best days to look for your buy candidates is when the market is dropping, because if you can find stocks that are rallying during a negative market day, that's a sign of strength in those individual stocks. Now, right away, looking at this, there's no question this stock is in an upward sloping trend. You see that? Now, if I take this low from back here on October and I connect it to these lows back here, right through May and June and extend that out, there's my trend line. So what's going on with the price of the stock? Well, we have the stochastics oversold, the CCI oversold, Now, again, the momentum indicators are still pointing lower, so you have to hold back. This is when you got to sit on your hands, all right, Ron? It's hard to do that because you think, okay, I'm hitting a bottom here. But I would follow the CCI on this one. And if tomorrow the CCI turns up and you see the stock is still above that trend line, even if it's a negative or red candle and it's above the trend line, if the CCI is higher, I would buy it, and then I would put a really tight stop. So if I bought at 31.63, I would put my stop around 31. I wouldn't even go all the way down here and set a stop way below the market, right? Now, one thing I want to check, because it's always a good idea to check the weekly chart, and that's not a bad idea. This is still in an upward sloping trading channel on the weekly chart. See, this is a nice candidate, and one that you definitely want to keep on your watch list. Now, the other part of the question is that if I get in, where would be a good exit strategy, right? That's always a good question you have to ask yourself, especially before you get into the position. Well, in order to find the answer to that, you have to go back here to find where the resistance points are. All right, so Ron, the resistance is very clear. The good news is, if you get in and it starts heading higher, you could trail your stop, excuse me, up with the stock. All right, so you still have almost 2.5 points of upside potential before you really have to worry about this one failing to break out of resistance. So if you get into the stock on a CCI turning higher, and then you start to see the stock going up, what are you going to look at? If the stock rallies and it looks like it's moving towards resistance, all eyes are going to be on the volume down here. Because if the stock is going up and you start to see the volume dropping as it's approaching resistance, boom, that's your signal to get out, take the profit and run and wait for another trade, right? And Ron, if you get in HCP and let's say you don't want to get out of the trade as a stock position, then you might want to maybe consider selling some calls against it. They do have options, and that's another opportunity for you to be able to take in some cash on that. All right, Steve, welcome back. Steve, you're one of our regulars. I really appreciate you being on with us each and every month. Steve is looking for an entry point in Snapchat, SNAP. I'm not really that bullish on the social media networks. What's happening, I'm noticing, is I don't know if any of you subscribe to my Option Oracle alerts on Twitter or Facebook, but I'm pulling away from Twitter. I'm kind of getting overdone with all the tweets and the garbage and the false news and everything else. I'm sticking more with my news feed. What I do is I open up my browser and I set up different news sources. I might have CNN, I might have CNBC, I'll have Reuters, I'll have, I even keep Drudge up. I'll have different news sources, and what I do is I scan my web browser for any news. That's number one. Number two, I also use Yahoo Finance on my smartphone. Now I have an iPhone, and if you folks are not using Yahoo Finance, I would encourage you to do that, because you have your charts on there, but you could also set alerts and you could be notified when relative market news is hitting the market, and you get it in a very timely fashion. So if you're not using Yahoo Finance for your news source on your smartphone, something to consider. And now I'm going back to analyzing Steve's stock right here. This, to me, looks like it could very well be a buy candidate right here. But again, look at the signals. CCI is starting to turn up. Is it a buy signal today? Let's see. Hold on. Did it cross over? No. See, on the downside, the buy signal is created when it crosses over the -100 mark. So if you see that tomorrow, that's a buy signal. See how the CCI is starting to turn up before the stochastics is turning up? Again, another indication of how sensitive that is. You have a higher low, but a lower high. What is that? Well, that's called the half signal. Let me give you another quick TA classroom tip, right? Here you have a big red candle. I'm going to say this quickly. Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, low, low, lower high, higher low. It's not a lower low. So when you have a higher low following this sequence of lower highs, lower lows, that is called the half signal. Half signals are fairly bullish. And when you have this small candle falling within the body of that red candle, that is a very good bullish sign. So again, you're looking for an entry point. I would say tomorrow is the day on a contingent basis now. If during the course of the day, it doesn't have to be the close, but if during the course of the day you see the CCI moving over the minus 100, get in and then immediately set your stop. Where are you going to set that? I would set my stop below this low right here, give you enough room for the stock to breathe. So if you buy it at 415, 416, 420, 1420, whatever, put your stop right below 1338, maybe 1325. Give yourself a little bit of room. Give like $1.50 risk per share, and then trail your stop as it goes up. Your target price for this one could very well be the high up here at 16. This is not going to be a home run for you, but it could very well be a nice trade and a strong percentage move if you look at it. Because if you get it under 1420 and it rallies up to 16, that's not a bad trade. And it's not going to happen overnight. It'll most likely take a week or two to get up there, but that one could be a good one for you as well. Yeah, we still have a lot of time here. Let me go to Ken. Ken says, let me just read this. You brought up an interesting point in your intro. So my question is, if you have a monthly pattern and a weekly pattern and a daily pattern perhaps that differ, does the monthly pattern outweigh the weekly, etc.? Yes, absolutely. The weekly trumps the daily. The monthly trumps the weekly. And if you're a day trader, you may not care about any of those because you're in and out in mere minutes. But a monthly bearish engulfing pattern definitely outweighs any other signal that you have on the weekly. And that's why when I looked at the Dow and I saw all those bearish engulfing patterns stacked up one after the next, I don't remember any time in my career where I have seen that many bearish engulfing patterns stacked up at the top and not have a big move lower. All right. Today, big news. They raised the debt ceiling, folks. I don't think it doesn't matter what political flag you fly. We are way beyond, as a nation, we are way beyond the point of no return. There is no way in our lifetime they're going to even make an attempt to cut down on spending. It's not going to happen. It's like they're writing blank checks and they're spending taxpayer dollars. I'm going to tell you, as scary as that is from an economic standpoint, it's actually a great opportunity for those who are preparing for an economic pullback or collapse even. You could make a lot of money on the way down. And I would hate to have any of you stuck at the high with a long position because you weren't paying attention to a bearish engulfing pattern. The technical signals are going to be much more sensitive than any economic news you're going to get from the Federal Reserve. The Dow theory, if you look at Dow theory, if you study Dow theory, the price and the charts discount all of the news and economic data. It's already in the price action. So when you start to see moving averages rolling over, if you see the volumes dropping, if you see engulfing patterns, like we said, if you see the indicators, momentum indicators shifting, you could not say to yourself, I've been buying since 2008. I'm just going to keep buying, and that's my strategy, because you could wind up giving back 11 years of profits. If you got in at the end of 2008, you're in this thing 11 years now. And if you decide that you're going to let all that ride, it could take you another 11 years to recoup your losses if you get a pullback from the high. I say play it safe. You could buy stocks. Don't get me wrong. You could buy stocks on the technical buy signals. Just don't lay into them with all your buying power. And when we do get the rallies, get in the habit of selling into the rallies. And I'm not just talking about selling out of long positions. I'm talking about taking bearish strategies. And if you've never sold anything in your life as a short selling opportunity, then buy something that's inversely related. Let's say, for instance, the Dow. This is the ProShares short Dow 30. It's the dogs of the Dow, right? This is inversely related. So if you think the technical signals are looking really negative for the diamonds, then start taking long positions in the dogs right here. Because when this starts crossing over the 20-period moving average, guess what's going to happen? Remember, it's inversely related to the Dow. So, you can make money on the way down. You just have to know where to position your money. All right. Ken, that was a very long answer to a short question, but I appreciate that. You're welcome, Jim. I just see that. Paul Farley, how the heck are you? All right. I just answered your question already about selling spreads. Gene, you're in there. All right, here we go. Kim, I'm scrolling. I'm looking for the next stock symbol. Let's see, stock symbol. Here we go. Phil again. Boeing. Here we go. This is what I talked about earlier. I thank you for bringing that up. Now, Boeing, remember what I said in my expiration week alert, I told my option traders that I thought Boeing would rally. It has already done that, and it continues to do that. Even today, we set a higher high. Now, at the beginning of July, right around this area, Boeing was trading under 360. It's already rallied 13, almost 14 points in a very short period of time. Now, my position in Boeing is I wanted to go back down to 360. As an option trader, I have what's called the calendar spread. I am short the 360 calls. I want Boeing to drop to 360, and I want it to just stay there. Well, guess what? The 20-period moving average is very close to my price. So I think Boeing could pull back to it. Let's get rid of all the lines and look one step at a time at what Boeing looks like. All right, because I know, Philip, you don't have a position in it, but be careful of this one because Boeing has had a lot of news with this, with the problems with its jets and the orders on the jets, and just be careful. There's still a lot of volatility in here. Now, Boeing today pulled back from a very well-established resistance point right there. One of the reasons why this is such a significant resistance is because back here was a gap. So this is not just a double top area gap. This is a gap fill resistance on top of it, right? This right here is a negative or bearish harami. Again, it's when the candle body falls within the range of the body from the previous day. So we have a red candle falling within the body of the green candle. That's as bearish as a bearish engulfing pattern, okay? There is a small gap below the market that's going to act as a price target, price magnet. I think it could easily pull back to it, and I'm being conservative, pull back to the 20-period moving average. On top of that, stochastics is dropping. CCI is dropping. The volume is dropping. Every technical signal that I'm looking at on Boeing right now is showing a negative sign, right? Now, does that mean you should never buy Boeing? Of course not. If you look, we have higher lows forming. So this general area right here, by the time Boeing drops, this 20-period moving average is going to be matched up with the trend line. So this area right here could be a new buying opportunity. So what do? You put a price alert, right? And say, okay, I'm going to set a price alert. I right-click my mouse if you're using the TD Ameritrade, create alert. There we go. And what is that? I'm going to put 362. Just type this in. Okay, I'm going to just put 362 even. Bum, bum, bum. and hit create. Okay, so this area right here, right around that trend line and right around the moving average, is going to be my target. So when I get this alert delivered to me in email form, I'm going to know what to do. Now, I didn't take the time to add a note, but most of these alerts that you can set on your chart, you could add an alert. So if I say, okay, mark, 362 and send me an alert when that happens, I could add a note, time to buy Boeing, or consider a long position, or buy calls in Boeing, whatever. You give yourself a memory jogger to know what you're supposed to be doing. See, you don't have to sit in front of your computer all day long. I certainly don't. Some of you think I watch the markets all day long in front of my computer. No, I actually have a life. And I spend a lot of time recording and developing content, but I don't sit there with a bad case of tickeritis. I don't. I sit there and I do things. I live my life and I let the technology do the work for me. And that's going to be a great thing for all of you if you learn how to use the technology. Now I'm going to go right along because there's one more left, and that's with Kim. That's the crazy trader lady that I call Grasshopper, right, Kim? Kim is part of our mentoring program as well, and she's looking at Intel, INTC, looking bullish, role reversal crossing MAs. Well, here's the thing, Kim. It is looking bullish. However, the only thing that's popping off on this chart to me is this right here. Today, that's a big, strong green candle, but it's on lesser volume. It's about 15% less of what it was on Friday. So if you're thinking about buying this one, it's not telling you not to. It's just saying buy it with caution. So instead of me putting my stop below the 20-period moving average after buying it, I'm going to be more conservative and put my stop maybe below today's low after I buy it. That's it. That's all I'm going to do. And that way you have a more conservative approach. The other way is to, again, here's one. The gap could very well fill on Intel up there around 58. That would be a role reversal resistance. After a gap fills, like I think that will one day, 80% of the time after a gap fills, what happens? It reverses and goes the other way. That's why it turns into resistance. Before I wrap up, I want to tell everyone next Tuesday and Wednesday, I'm going back into the recording studios to put the final video touches on my technical analysis course that we're putting out. We're using a new platform to launch this, and I'm building this up. It's a 20-class technical analysis course that we're marketing, get this, for $14.99. We're going to be selling tens of thousands of these courses, and we're doing it through a program that's similar to the way iTunes works. When you buy a song on iTunes, you spend what, 99 cents, $1.25, whatever it is. This platform allows us to hit the masses in large numbers, which allows us to dramatically drop the technical analysis course. Now, that is completely separate from my mentoring program, which is one-on-one coaching. All right, so I have 2 spots opening up at this month. I don't see Ron on here with us, but Ron is taking one of those 2 spots at the end of this month. And I will have one more spot open in about a week and a half. So if you're interested in the one-on-one coaching, just send me an email and I'll be happy to reserve that spot for you. Otherwise, we'll have to wait another month to get in on that action as well. So I had a good time. That's a fast hour. I hope you enjoyed it. I certainly did. Stay tuned to the market, guys. Make sure you download or at least watch the weekly market reports so that you get an eyeball on the markets and which way it's going. And most importantly, make sure that you're protecting yourself with stops and following the 1% rule for managing risk. So that's all I have for tonight. Have a good one. We'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.